You might have heard that Buy Now Pay Later, or BNPL, is going through a rough patch. BNPL giants have seen their share prices plummet, valuations slashed, and significant cuts to their workforce. Klarna's July funding round reduced its value to just under $7 billion from $46 billion in mid-2021. But what's next for these fintechs? Let's take a look at some of the big shifts and what they might mean for an industry under stress. First up, inflation. High inflation poses a big risk to BNPL providers. They rely on low interest rates, as profits come from the difference between what they spend lending money to consumers and what they earn from providing their services to merchants. With rising central bank rates, providers face a clear and present danger: significantly reduced margins owing to an increase in the cost of borrowing. And that's not all. Rising living costs are also threatening the industry's longevity. High energy, fuel, and food prices are reducing consumers' disposable incomes. This is limiting their appetite for buying discretionary goods such as clothes and cosmetics. Even with the option of a BNPL solution at checkout, consumers are increasingly thinking twice about making those purchases that they otherwise couldn't afford. And what about customers' default risk? Companies are reporting growing losses, driven primarily by delinquency on loans, Afterpay and Affirm included. Customers can't afford to pay back what they've borrowed. To counter this worrying trend, should BNPL providers change the way they assess the creditworthiness of their users? Since June the 1st, firms have been working with credit reporting agencies in both the UK and US to include BNPL borrowing on consumers' credit files. For example, Klarna UK now reports the use of its Pay in 30 and Pay in 3 products to Experian and TransUnion, including those purchases made on time, as well as late and outstanding payments. This will help customers with thin credit files build credit history. It also gives providers a more accurate picture of individuals' creditworthiness to prevent them taking on customers who are likely to default. However, there is a potential downside for customers. If this change in reporting is not properly communicated by lenders, then BNPL users could face long-term damage to their credit score for late or missed repayments. I believe that BNPL providers need to make fundamental changes to their business models in order to survive. They need to work harder to understand what customers really want and win back their trust through transparent, responsible lending, particularly as the industry comes under increased regulatory and media scrutiny. Not to mention the increased competition in the space, from both big tech and big banks, such as Virgin Money and NatWest, who've recently launched their own BNPL offerings in the UK. And the biggest challenge comes from Apple, who launched Apple Pay Later in June this year, in the US only, for now. All eyes will be on the BNPL industry over the next 6 months, as businesses are forced to adapt to the changes that have rocked them in recent times. How they contend with rising inflation rates, the cost of living crisis, customer delinquency, and an ever more competitive market that now includes the likes of Apple will separate the BNPL mainstays from the rest of the pack.